2022 has been all about inflation and central banks hiking interest rates to fight inflation. Now, what that means for the man in the street is higher interest rates mean higher mortgage rates, so that hurts people's ability to buy and pay off a mortgage. But it actually impacts the broader economy in multiple ways. And this is sometimes where it's tricky for retail investors to follow how movements in financial markets actually impact the real economy and everyday activity. If you think about it, when someone like the Bank of England or the Fed hike interest rates, there's that feed through to the mortgage market, but it also affects a raft of other things. It might make the currency stronger. It might cause credit spreads to widen, and that just means that corporate borrowing costs become more expensive. It can affect lots of different things, including pushing equity markets potentially lower, hurting people's perceived wealth because their savings have been eroded. So it's important to think about all these different channels and how these rate hikes are impacting overall financial conditions. What the market tends to do is we create something called a financial conditions index that measures all these different ways that monetary policy is impacting the real economy and try and bring it all together into a single number. And that's what we've done here with the eyeQ QI credit impulse. We have one for the States in red and one for Europe in blue. The way to think about this is when financial conditions tighten, central banks are hiking rates, currencies are getting stronger, corporate credit spreads are going wider, then that results in the credit impulse going down. Credit conditions are getting worse for people, for companies, for everyone. You can see, for example, during the first lockdown at the beginning of 2020, how severe the credit contraction was for US and Europe. But if you cast your eye to the beginning of this year, you can see that apart from the 2020 lockdown, credit conditions got as tight as they have in the last 10 years plus. This was the Fed fighting inflation by tightening financial conditions, the move lower in those lines. But you'll see over the last month or so, both in Europe and in the States, we've seen a sharp rise in these lines. Credit conditions have gone back to neutral, the zero line, and now they've actually gone into positive territory. The credit impulse is saying that financial conditions have actually gotten easier in the last couple of months. Now, given the Fed are, yes, they're easing up in terms of the size of rate hikes. They're probably going to move to 50 basis point rate hikes rather than 75. But at the same time, they're stressing that they need to keep interest rates high. They need to keep financial conditions tight for longer while they fight inflation and see inflation really roll over properly. Arguably, this easing of financial conditions, this increase in the credit impulse that you're looking at in this chart, is really kind of moving the wrong way with regards to how the Fed and the ECB and the Bank of England will think about things. It's worth keeping an eye on this, and eyeQ will update you frequently.